Hi everyone. Myself Dr. Bharath, Assistant Professor, Department of Management from Kristu Jayanti College, Bangalore. So today I am going to give you the important topics in financial management, that is the cost of capital. So the cost of capital is important and controversial area in the financial management. So in financial management, the cost of capital is very important in taking many decisions like capital budgeting decisions, dividend decisions, and the capital structure decisions. So this is an important one. So that is why we are discussing the cost of capital in this class, in this session. So now the cost of capital. So cost of capital is the one of the important concept in the financial management. So first the capital structure will decide so what exactly the cost of capital. So we'll see what the meaning of the cost of capital. So cost of capital meaning and introduction. So one of the professor, so he given the definition what he mean by cost of capital. So cost of capital is the discount rate used in evaluating the desirability of the investment project. Though the cost of capital is a minimum rate of return required for the investment projects. So in financial management, so investment projects are totally depend upon the cost of capital rate, that also we call it as the discount rate. So based on this discount rate, we are going to evaluate the project, whether to accept the project or to reject the project. So this cost of capital gives you the minimum rate of return. So what should be the minimum rate of return the company should earn from a project? So the cost of capital is a minimum rate of return which will maintain the market value per share at its current level. If the firms earns more than the cost of capital and the market value per share is expected to increase. The cost of capital, the rate indicates it's a minimum rate that company should maintain. If the any project that earns more than the cost of capital, so then the market share automatically increase, the shareholders and the stakeholders will get the benefit from this. So based on the calculation of this cost of capital, that is the minimum rate of return, will directly impact the share price of the company. So that is why we are going to see how to calculate the cost of capital and what are the cost of each specific cost we are going to calculate. So the next slide. Importance of cost of capital. So what is the importance of cost of capital? So why we require the cost of capital? The first and foremost is capital budgeting decision. In capital budgeting decision, where the capital budgeting decision may be a new project or the modernization project, or we want to invest any new projects or any new projects, any long term new projects, the decision is based on the cost of capital. If cost of capital decides whether these capital budgeting decisions will be accepted or not. So for example, when we are using the net present value or when we are using the profitability index, so we are going to consider the cost of capital or the discount rate to evaluate the projects. Whether the projects are accepted or rejected, it's totally depends on the cost of capital. The second one, important one, is the capital structure decision. Capital structure decision means when you are raising funds, for example in the capital budgeting we need we identify the projects, and after identifying the projects, so we are going to identify which source of finance is the best for us and what is the cost of each source of finance, whether to issue the new shares or preference dividends, or to issue the new bonds or debentures, or getting loan from the financial institutions, or we can use the internal source, that is the retained earnings. So these decisions will be depend on the cost of capital. Cost of capital tells you which source of finance is having the highest cost, which source of finance is having the less cost. So based on that, the capital structure is going to be decided. So which source we are going to identify. The third one is evaluation of financial performance. Evaluation of financial performance means when we have a cost of capital, for example, when the company is earning more than the cost of capital, so we can compare with the other companies, other industries, and we can compare what we are expecting a minimum investment from a project. So for that purpose, we need the cost of capital. So then other financing decisions like dividend decisions, then the working capital decisions and risk management decisions also require the cost of capital. The next slide. What are the source of finance? So there are different source of finance. So usually based on the time, it divided into three types. One is the long term financial needs, the medium term financial needs, and the last one, short term financial needs. The long term financial needs. So when the company wants to do the business for a long term, so they need a long term financing capital. So like equity shares, debentures, preference shares, bonds. So these are all long term financial needs. So these long term financial needs are issued more than 5 years. When it comes to medium term finance, the time zone is between more than 1 year to maximum 5 years. So these funds can be used for a working capital management or any emergency funds in the organization, they can be used. In the short term financial needs, it will be less than 1 year. So like money market instruments like call money, treasury bills, and certificate of deposit. When the company requires a short term finance like working capital, buying a raw materials, all the short term emergencies, all these requires a short term finance. So the company can get the short term finance from the money market or from the financial institutions. The next one, so the classification of financial source. The financial source divided into two types. One is the external source, another one is the internal source. The source of finance, external source and the internal source. The external source like the share capital and debt or borrowed fund. So the share capital divided into two types. One is the equity shares, the another one is the preferred or preference shares. The next one, in the external source, company can issue debentures or debt or bonds to the investors, so they can raise money and they can invest in the business and they can do the operations. In debt or borrowed, so debentures is one of the companies, normally they are issuing the debentures, and the borrowed funds like they can get the loan from the financial institutions for a long period of time. And others like bonds are the other types of external source. The company can issue bonds to the investors and they can raise money and they can do the everyday transaction, everyday business. The internal source, the internal source mainly have the retained earnings. So when retained earnings means, so when we issue the equity shares to the equity shareholders, after getting money, so we are doing business and we are getting a profit. After getting profit, so we can either distribute to the shareholders or we can distribute, or we can retain in our balance sheet or in the company. So that portion we call it as retained earnings. So why we are retaining the profits in the company? For investment purpose, for further reinvestment process, for any emergency purpose in the organization. If any emergency comes, so we can use the retained earnings. So these retained earnings funds also available to the shareholders, but so these can be used in the organization for investment of future projects or emergency funds, or they can distribute to the shareholders at any point of time. So that is the company choice. Next video will be the computation of cost of capital. So how to compute each source of capital we are going to discuss. Thank you one and all.